Hello and welcome to this week's edition of the Retirement Compass, the show dedicated to helping you successfully navigate to and through your retirement. I'm your host, Kristen Oakley, and joining me in the studio is Tim Kulhanek. He is the co-founder and a financial advisor at Stonebridge Wealth Systems. Tim, my friend, great to be back with you another week.
Yeah, same to you.
Are you enjoying sitting in the chair that normally Jeremy sits in?
Yeah, he got evicted, so here I am.
Oh, well, you guys are always such a joy to be with, and I'm excited to have this conversation with you today as well.
He'll be back, don't worry.
Yes, no worries. Well, we're having a great time, and we're so glad that you are joining us today on the Retirement Compass, and we're going to be talking about something that is, I think, at the top of everyone's minds, Tim, and I'll be curious to hear what you are hearing in the office when folks come in to meet with you, but obviously there's a lot going on in our world right now. There's a lot of concerns about where the economy is heading from a political perspective, what's going on in our country, and it has a lot of folks nervous and concerned. We actually have a study, this is according to the most recent financial security survey by AARP, and it said that 60% of investors age 50 and above say they are worried or very worried about the security of their retirement. In addition, a study by Fidelity found that the median 401k balance for today's baby boomer retiree is only around $61,200. I have to say, I was shocked.
Shocking.
When I saw that.
No, it's median, not average. The average is some like 224,000, but that's, I mean,
still,
if you're making 100,000 a year, that's 2 years of income.
Right. Well, and then we talked on a previous show not that long ago about healthcare costs and how on average most people, if they reach the age of 65, are going to need to spend $300,000 alone on healthcare costs.
Yeah, the reality is that knocks a lot of people out. When we're doing our Monte Carlo simulations, the potential need for hundreds of thousands of dollars of long-term care, you know, you go from maybe a 92 probability of success to 2. You lose the 9.
Right. Yeah. So people have these balances. It's maybe a lot less than what we realize of what people have saved up for retirement. But then we have the whole issue of market volatility. And in these volatile times, a lot of folks are concerned about protecting what they've accumulated and not subjecting it all to the market. So that's what we're going to be talking about today, is how to really navigate market volatility successfully.
Correct.
So yeah, where do you want to start with this important conversation?
Sure. So I think we got to realize that today's retiree, the baby boomer generation, you know, we've still got 10 to 12,000 retiring every day, reaching age 65 at least, for another like 5-6 years. So they've been through an awful lot. Let's go back to 1999. Tech stocks are booming. The economy is churning out big returns. GDP is amazing. And it looks like there's no end in sight. Unfortunately, what we find time and time again is there's these cycles of like euphoria, and that's when people usually tend to make some bad decisions with their money. They get too aggressive. They start putting money in places they normally wouldn't, taking risks they normally wouldn't.
Right.
And then, unfortunately, when it comes to bubbles, you don't know you're in one until after it bursts, typically. The dot-com bubble burst, and all of a sudden you had a 3-year bear market, 2000, 2001, and 2002. Throw in the fact that there was a ton of government spending in there. You had the repercussions from 9/11, Iraq and Afghanistan conflicts, a major Medicare prescription drug bill that passed, 2 or 3 tax cuts, and all of a sudden you've got a situation where volatile markets, major government intervention, and, you know, fast forward to today, and it was just 4 years ago. Time seems to like go faster and faster in the digital age, but we went through the pandemic in 2020 with the market where there was a 30% decline, actually 35% decline in the S&P 500. That was the fastest 30% or more decline in history.
Wow.
Now, thankfully, it was a V-shaped recovery, but sandwiched in between those two big events, the dot-com bubble and the COVID pandemic, was what? Closer to the dot-com bubble. The 2008 Great Financial Crisis.
Right.
Biggest drop in market since the Great Depression, wiped out billions of dollars, trillions of dollars in wealth overall. You had people losing their houses, you had 401ks that some people say it turned into a 201k or something like that. And so they've been through a lot, so they're rightly to be concerned about what's going on.
Right, and that's the hard part, is we don't know what's going to happen, right? And that's true no matter what season our country might be in, what's happening in the world out there. So we have to have a solid plan in place to be prepared for no matter what happens. And I think that's, you and I both know that a lot of peace of mind can come when you have that plan. Of course, adjustments have to be made depending on what's going on. But you and the team of Stonebridge Wealth Systems pay attention to the financial currents. You stay on top of what's going on. and you're able to be proactive in building these plans to help folks navigate these challenges successfully.
Absolutely. So obviously one of our key roles as financial advisors is to make sure that we're giving input on the capital markets, right? So we're monitoring them on an ongoing basis. Now we use a team approach because we're holistic advisors. So like Tim isn't going to be the guy that's sitting in the conference room meeting with you, putting a strategy together for what account to draw from, when to draw Social Security, minimizing your taxes, tax loss harvesting, QCDs, all these different things that go into a comprehensive plan, and be sitting in front of the computer at the same time looking at financial data and doing financial market research. It does take a team approach, and so that's what we do at Stonebridge. But here's what we found. If you look over the past 25 years, this wild ride I was outlining, the S&P 500, this is from Yahoo Finance, it's increased over 270% since January 1st to 2000. That's really good. But it's actually only a rate of 5.48%. We went through something called the lost decade from 2000 through early 2010, where basically you were treading water. The reason why your account balances went up, by the way, for our viewers out there, in your 401ks is because you were putting money into them. It wasn't really because the markets were giving you returns that was increasing capital appreciation, so to speak, because there was all these ups and downs. And so there are other considerations that we have to kind of pull into an overall plan, and one of them is what we call behavioral finance. Okay? Understanding that the reason why most investors aren't successful is because they just have a really hard time sticking with things. There's a study that I looked at from, and this is recent, from Morningstar. They actually come out with a study every single year. It's called Mind the Gap, and they evaluate the gap between investor returns and official market returns. In other words, do-it-yourselfers. How do they do versus the market? And what they found was do-it-yourselfers tend to underperform the market by as much as 1.7% per year, while day trader investors, those who we often think of as possessing some high skill level, like, oh, they day trade, they must really know what they're doing. They tend to actually lose money over the long run with a failure rate as high as 80%, according to an online trading platform called eToro. So this is why we remind our clients when they think, oh, I'm going to go in and buy and sell and buy and sell. There's the old saying, Rome wasn't built in a day. Well, in the financial services industry, if you're an investment manager, they often will say, well, yeah, Rome wasn't built in a day, but Hiroshima and Nagasaki were destroyed in a day. So that's how fast you can lose money if you're trying to get too cute with your investment strategy.
Right. You were talking about 08, and I think that one of the biggest things that was so detrimental to so many folks is that a lot of people didn't have a plan for that kind of volatility, and maybe we're planning to retire during that time. Guess what? The markets don't care when you're planning to retire. They're going to do what they're going to do. There is something known as the sequence of returns risk that I know we need to address, because this is something that I think a lot of people aren't familiar with it, don't understand how it works, and yet this can be so detrimental to someone's success in retirement. So let's talk about that.
Yeah, I think this is a great way to kind of close out this segment. The reality is sequence of returns risk, it's a real thing. It's one of the most critical things that you have to understand going into retirement. And so what I want to do, we're going to pull a graphic on the screen here that will show you to kind of help illustrate what sequence of return risk is. So what you're looking at here is a return period going from 2000 through 2023, so 24-year period, and it's just the S&P 500. So it's not an investable index, it's just the index itself. SPX would be the symbol. You can find it online on Yahoo Finance. And you've got the returns in chronological order, 2000 through 2023 on the left-hand side, and then we just flip it. And we do 2023 through 2000. And the reality is the average return is the same over this time period. There's no withdrawals. We're assuming you start with $1 million. And at the end of both these periods, you have the exact same number. Bottom right of the left and the right, you see you've got $3.2 million. It doesn't really matter when the returns come and go, if they're good in the beginning, bad later, or vice versa, you've got the same dollar amount. Now we're going to show the next chart. And this is where it gets really important. I want everyone to understand. Now we're introducing a distribution. And now, on the left-hand side, you got 2000 through 2023, and you're taking 5% per year. Now, I'm not adjusting for inflation. I'm going to keep this super high level and simple. Intuitively, you're like, well, Tim, that doesn't change, right? Because you showed me on the first charts that it doesn't matter when the returns happen. That's where sequence of returns risk comes in. Because on the left-hand side, if those bad returns happen they're front-loaded, like the 3-year bear market I mentioned at the beginning of the top of the show, you have not only those withdrawals of $50,000 a year, but you've got 10%, 13%, 23% declines. Under that scenario, you are out of money by 2018. You flip it, and you get those bad returns later on, I don't know about you, but I'd be okay still having 1.6, almost 1.7 million.
Right, and that's the staggering thing that folks have to understand, the timing of all of this, which we can't control. We can't control what the stock market's going to do when. We know it's only going to do one of two things. It's going to go up, it's going to go down. But I love those charts and that illustration. I know the numbers might have been a little small to see, but that's the point. The point is that when those losses occur, if you are on a fixed income, if you are withdrawing income from that account to live off of, and you're experiencing those negative return years at the beginning of your retirement, it's potential that you may not recover.
Absolutely. So that's why for the rest of the show, what we're going to talk about is we're going to talk about a really important study that came out recently from Ernst & Young. Now, Ernst & Young, they're not some vendor of mine or something like that. Ernst & Young's a giant accounting firm, multinational firm. So they're auditors. And they put this study together where they wanted to know, okay, how can we guard against this risk? What if we started introducing things like what they refer to as volatility buffers, which I'll explain here in a moment. And what they found was staggering. What they found was if you put a strategy in place, and again, this comes with what I call a comprehensive plan. What we're offering today is a complimentary written financial plan, which would include all these different areas. If you include what's called a volatility buffer, you can not only increase the amount of income that you can withdraw per year in retirement, but actually leave more money to the next generation. And we know there's this huge investment gap, not only for today's retirees, but even more so for the next generation. You can leave more money, take more income, and enjoy a higher probability of success, which seems counterintuitive. You can do it if you put the right pieces in place. So that's what we're going to go over for the rest of the show. For now, give us a call at the number at the bottom of the screen, and we can have that one-on-one, give you a second opinion. You can't get a second opinion from the person that gave you the first, so we'd be glad to do that for you, complimentary, and give you that written financial plan.
Wonderful. Tim, thank you so much. Such jam-packed good information. We've got a lot more for you, but this is a great opportunity for you to pick up the phone and call to claim your complimentary written financial plan from Tim and the team of Stonebridge Wealth Systems. That number to call is 866-256-7778. Or if you'd rather connect online, you can simply pull out your smartphone, and if you open up that camera app, just point, click, and scan the QR code that you see there down in the bottom right-hand corner of your screen. That will take you over to a landing page, ask you a few short, simple questions, and then a member of the team will reach out to connect with you to schedule your complimentary meeting that way as well. We'll be back with more right after this.
My story started when I was in college. I was trying to figure out what I wanted to do. I knew it was going to be in the financial industry. I took a lot of accounting and finance classes. I thought I'd probably work in like a bigger company and work my way through maybe the accounting department. But then when I was doing a internship the summer before my senior year, I walked into a business. I was trying to sell magazine ads. I don't know if I call it magazine ads, but basically ad space in the back of the UNK student handbook and planner, which was a difficult sell because, nobody uses pen and paper planners anymore, at least not college students. But I made my best pitch to some financial advisors. I happened to be Scott Noctegal that I met with that day. When I went for the close and tried to see if he was ready to sign up for some ad space, he said, yeah, no, I'm not interested in that, but it takes a lot of courage to have somebody to be willing to walk into a business, especially a business that really doesn't cater to your target audience, to put yourself out there in a way that the odds of you being successful are probably pretty low. That's the type of person we'd be looking for at our firm. Have you decided what you want to do? And I said, no, I really haven't, but I only want to work with finance because I like numbers, and math's always been my favorite subject, and working with kind of complex equations, almost like a puzzle. And so that's really where it all began.
Welcome back to the Retirement Compass. I'm your host, Kristen Oakley, here with Tim Kulhanek, co-founder and financial advisor from Stonebridge Wealth Systems, and a very important conversation we are having today all about market volatility and what it means for you and how you can be proactive and take steps even now, no matter where you are in your retirement journey, in order to make sure that you can protect the wealth that you've accumulated. And Tim, you mentioned this concept of having a volatility buffer in the previous segment. Can you explain what that actually means and what that tangibly looks like for folks?
Absolutely. So I'm going to just use the definitions that I got from Ernst & Young from their study, because that way folks out there know, and in our audience, that you can go online and get this study. In fact, if you give us a call, I'd be happy to send it to you. It's available online. There's no cost for that, and it's in PDF form, so we can send you a digital copy. Here's what they did. They said, we're going to look at volatility buffers And we're going to look at using permanent life insurance. So like in their study, they used whole life insurance. You could use universal life. We in our firm typically use index universal life. And then a deferred income annuity with rising income. So in other words, at a specific age 55, they would take a chunk of their retirement dollars and add it to a deferred income annuity with the idea that, hey, that's safe money, that's guaranteed money because it's backed by the claims paying ability of a large A-rated insurance company.
And it can't lose once it's in there, right?
Hence the volatility buffer.
Right.
You know, I sometimes say it's almost like if you went over to Warhorse, put $1 in to the machine. If there was a machine where the only two options were either you win or you push, so either I make money or I don't lose money, that's kind of the idea here with a volatility buffer. It's got to be a secure money location. So they compared investments only, so just play in the market, term life insurance plus investment. So thinking, well, what if you die prematurely? Then you're going to leave more money with this term life insurance policy via the death benefit to your beneficiaries. Permanent life insurance, such as whole life, but could also be universal life plus investments. And then the deferred income annuity with increasing income potential. For example, an indexed annuity, which is we typically use, especially today in the interest rate environment we have, with potential for increasing income. And then you're also adding in investments with that. It's not an all or none type of situation. So that's the different combinations they looked at is, okay, which one gives us the best return?
Wow. Okay, so all these different pieces, how does one even go about figuring out what kind of volatility buffer might be right for them?
So let's just I'm just going to summarize the study. And basically what they did is they said, okay, so we want to make sure that we've got a 90% statistical probability of success. So one of the things we do for all of our clients that come in and folks that come in for the written financial plan is they say, I want to plan. I want to know if, obvious question. When can I retire? Right. Do I have enough? Will my money last as long as I need it to? Will my family be okay if something happens to me? We can answer all those questions, and as part of that, we do what's called a Monte Carlo simulation to say, hey, well, what if there's really bad returns early on? Remember our sequence of returns? We want to account for that. What if tax rates go up? What if inflation's higher than I thought it was going to be? What if Social Security, something happens there and they cut benefits? So this Monte Carlo simulation will run 1,000 different simulations to see, okay, out of 1,000 different potential outcomes over the next 35 years, how many doing what I'm doing would I be successful? So the study said we want to maintain 90% or better. And in general, they said, okay, we could put 10% of our savings into life insurance, we could put 20, we could put 30. And then when we get to age 55, we can put 10% of our resources, our overall nest egg, into some volatility buffer, if you will, deferred income annuity, 20%, 30%. That's where they start, and they say we want to maintain a 90% probability of success. Which combination gives us the best outcome? Does that make sense?
Yes, it does. Yep.
So here's what they found. What they found was if you put 30% of your dollars into private life insurance and 30% into a deferred income annuity, it could potentially increase your annual income by as much as 8.2%, or if you focused more on, let's say you want a bigger focus on estate planning and you're worried about, hey, the next generation, I want to make sure they're okay. Right. You use the life insurance strategy, more focused there. It could boost the amount you leave to the next generation by as much as 20% over investments only.
Wow. Wow, that's a big difference.
Huge.
And when you say 20%, then when you put that to a monetary amount, that just brings it home for folks too, right?
Yeah, I mean, think about it. If you had $1 million, how would 1.2 million sound, you know?
Right. Yep. All right, so that's just stunning. So, I mean, this is the deal, though. I think a lot of people hear that and they're like, is this too good to be true? I mean, who wouldn't want that kind of opportunity, right?
Yeah.
So what do you say when folks are trying to figure out, oh my gosh, how does this work for me?
Yeah, so in other words, like there's a lot of big firms out there. I don't mean to necessarily mention them by name, but big box retail firms, and they say, oh, we don't do life insurance or we don't do annuities. The question becomes why? Now, they might tell you that because, well, they don't make any money, that's just, those are people that are just after sales commissions or something like that. Look, I'm a fiduciary. I have a moral, legal, and ethical obligation to put my clients' interests ahead of my own in everything that I do. Yep. And I think it's really for the same reason that a lot of firms don't advocate for Roth IRA conversions, even though pretty much all of us can see that with the amount of money the government's spending, you think, what did Larry Kaltikoff say? He said that, so he's a Boston University economics professor, and he said recently that the U.S. government would actually have to have $240 trillion in a bank account earning treasury rates today in order to meet all of their obligations that they've made promises for for Social Security, Medicare, Medicaid over the next 50, 60, 70 years. And so in other words, our government is wildly underfunding these obligations, these promises they've made, and they'll have to raise taxes. So Roth conversions make sense. Why aren't more people doing them? Well, if you've got $200,000 and you got to pay 20% in taxes, that's $40,000 that goes out the door to pay that tax bill.
Right.
That's $40,000 that brokerage firm, that advisory firm, doesn't get to charge a fee on anymore.
Right, that's 40% less than what they were managing before.
There you go.
Yep. And so therefore, even though it might be in the client's best interest, a lot of advisors out there aren't having these kinds of conversations with their clients. And that's why you really talked about the importance of having a second opinion and the fact that you can't get a second opinion from the same person who gave you the first.
Yep, absolutely. What I would follow up with this and kind of end the segment with this is the reality is this has less to do, I think, with the financial advisor as the individual and more to do with the firm's policies that they work with. It's one of the reasons why we're independent is we don't want to have to answer to a board of directors in some big city in an ivory tower that's going to tell us, well, this month, this quarter, this is our goal for what you need to go and sell, right? We want to be completely independent. We don't get any revenue sharing. You don't get any kickbacks or anything like that. It's also why we customize plans, because the reality is if you listen to some of the gurus out there, which we have no problem with them, they help a lot of people, the people that have the syndicated radio programs, they have to appeal to as broad of audience as possible, right?
Yep.
So if you listen to someone who is giving financial advice on a radio program, and it's going out in all 50 states, potentially even overseas, they've got to try to be able to give advice or recommendations or suggestions that apply to a broad range of people, but it's not going to be the nuanced, really personalized advice,
individualized approach, right?
That folks really need. So what we do at Stonebridge is we customize every single plan. And so when you look at the bottom of the screen and you see this complimentary written financial plan, you might think, well, what is that? What it is it's an outline of all the different things that might impact you financially over the next 30 plus years, however long we think your retirement might last. But what going through that process does is it looks at each of these areas, income, investment, tax, healthcare, and legacy. That's going to help you understand when should you draw for Social Security or file for Social Security. Are you eligible for any spousal benefits that maybe you didn't even know existed? Maybe one of the spouses didn't work outside the home or had limited work outside the home. And when the higher earner spouse files, that might be a trigger for additional benefits. I actually had someone in my office last week. She's receiving $600 a month from Social Security. When he files here in January, actually, of 2025, her benefit will increase by $800 per month because she's eligible for this additional spousal boost. A lot of people don't know that. You could do a lot. You could go on a pretty nice vacation for $800 a month. So we're going to make sure that you have that. We're going to look at your investment plan, make sure that if you need a volatility buffer, you have it and the right allocation to the volatility buffer. Taxes, tax efficiency, using the tax code as it's designed to benefit you, not Washington, D.C., and then making sure, like we talked about in previous shows, that healthcare costs are accounted for and that whatever you don't use goes to the people and places and entities that you love and care about, not to the government. What that means is you can stop worrying about it. You can put that to bed, rest easy, sit back, enjoy the ride, let our team of elite advisors focus on the nuances and the day-to-day and the market gyrations, and you focus on kids, grandkids, the thing you love and care about.
Wonderful. Tim, thank you so much. To our viewers at home, that number to call to claim your complimentary written financial plan is 866-256-7778. Or again, you're also welcome to scan that QR code and that will get you connected as well. We'll be back with more right after this.
Our team is very unique, so we all have different gifts. When you put it all together, it fits well.
Jeremy is definitely our most seasoned and fastest growing advisor we have. He's discerning, so he understands the way we want to do things at Stonebridge, to focus on the client and solving their problems, and that's really what he's passionate about.
I know Tim spends a lot of time making sure that all the I's are dotted and T's are crossed for his clients. And he's not just satisfied knowing the 30,000-foot view, he wants to get down in the weeds and know exactly how it works.
The things that you buy, the stocks, the bonds, the mutual funds, that really isn't that important to the client. What's important to the client is, what does this mean for me? And at the end of the day, what it means is they can sit back and listen to the music. You know that you've got a team, not just one person, but an entire team behind you that's taking care of those things, so you can focus on what's important.
Welcome back to the Retirement Compass. I'm Kristen Oakley here with Tim Kulhanek. We've been talking today about volatility buffers, what they are, how they can work for you, what some of the options are, so that you can make sure that you can protect your hard-earned money. Because really, Tim, at the end of the day, success in retirement isn't about how much you have, it's about how much you get to keep.
Correct.
And I know a lot of folks are concerned, especially given where we are in today's economic climate. We've seen lots of volatility. I want to go back because you were talking about this Ernst & Young study. I know you have some more information you wanted to share about that.
Yeah, so we were talking during the break, and one of the questions is, well, how do folks know how much they should allocate to something like this? So I found in my notes here where I kind of had the more detailed information. And so here's what the study found. Adding just 10% to the permanent life insurance strategy adds 1% to the annual withdrawal amount and 4.4% to your ending legacy value. In other words, what goes to your beneficiaries after taxes. Adding 10% to the deferred income annuity adds 3.1% in annual withdrawal. That would be a safe withdrawal rate, and 1% to your legacy value. When you marry them together, if you allocate 30% to the permanent life insurance strategy and 30% to the deferred income annuity, which would be at age 55, it adds as much as 5.4% per year to the annual withdrawal amount and a whopping 18.7% to the ending legacy value. So think about that. If your income was $75,000, adding these strategies could allow you to take more like closer to $80,000, $79,000 without having to fear about running out of money, and which is an increase of $4,000 per year. But even more importantly, over 30 years, that's an extra $121,500 that you could spend, plus have more money left over for your children. So at the end of the day, like Kristen said, it's not what you earn, it's what you keep that counts. And you know, a lot of people want to put their retirement on autopilot, and there's a time for that. But if you think about just flying air travel today, it's not what it used to be.
Nope.
But it definitely isn't. I can tell you that firsthand. But there's a time when it's on autopilot. It's usually in between the place you're leaving, right, your departure, and your arrival. But when do you not want that? When do you want to make sure that there's someone who's experienced, a seasoned veteran, a trusted ally at control of the wheel? It's during takeoff. And even more importantly, it's during landing so you can get there safely. We've landed that plane hundreds of times. We'd love to help you land yours as well.
Wonderful. What a beautiful analogy to wrap up today's show. Tim, thank you so much. And to our viewers at home, thank you so much for joining us. We know that a lot of what we talked about today might be new to you. It's not new to Tim and the team of Stonebridge Wealth Systems. You don't have to go it alone. They would love to be able to help and serve you. So again, that number to call to get your complimentary written financial plan, 866-256-7778. We look forward to being back with you next week here on the Retirement Compass.